Welcome back for another top-notch video. This week, guys, we'll be looking at the 18th of March through the 22nd of March. As always, this is a retirement TSP stock review channel. We go through the CSI and F funds for federal employees, including military. And if you're not military and you have just federal retirement accounts, we look at the ETFs, IVV, VXF, EFA, and AGG. With these funds, these are very good indice funds that follow big market indices in regards to retirement markets and whatnot. So the C fund or IVV ETF follows the S&P 500. The S fund or the VXF follows the Dow or the small caps, and then I fund or EFA follows international markets, and the F fund or AGG follows bonds. We go through both of these funds for the TSP investor and for the Roth IRA / 401k investor. If you have questions, you can always write them in the comments below. We kind of go over a general overview, and then we go into our more specific, in-depth guidelines for each of these funds. That being said, let's dig right into it. So what we have here is we're going to go over this week's funds and what exactly happened. So this is from TSPTALK. It's a website. They have great stuff there. There's a guy that does, named by Tom, that does commentary. Just go over the general funds and take a look at them. The first thing is for our CS and I funds, our stock market funds. They lost money or lost percentage this week, so just keep a note of that. And our bonds fund actually gained over 0.5%. We haven't seen that in a very long time with bonds. Bonds have been increasing this year, which has been something we have not seen in quite some time. And again, we have the G fund. We have a little note about that, and then they have the life cycle funds, which we don't usually address. That being said, let's go into some of the commentary Tom has from his TSP website. Again, you can find the TSP website by Googling TSPTALK, and you can find these same comments. So this week, one of the biggest market movers was the Fed. The Fed had some interesting things, and we saw the yield curve invert. So the Fed basically said that we were going to not be raising any more rate hikes in 2019. So that is very, very important. I don't know how long that will last, but for now, the Fed has been very different between their December and January rate hikes. They've kind of been all over the place, but for now, for what they've said, no more rate hikes. What that means is we can start looking at the F fund or AGG bonds for as a competitive fund again. We haven't been able to do that with them raising interest rates, because when they do that, it puts more pressure on that fund, and it doesn't gain as much, because when interest rates rise, bonds tend to fall. So that being said, we had those two events, the no more rate hikes in 2019, and then we had the inverted yield curve, which usually has related to some of the bear markets of the past. Doesn't mean it's going to trigger a bear market, but it has triggered the ones back in the 2008 and 2009 era, which initially happened. It was kind of an early indicator. It happened in early 2006, and then we got that recession in 2008 and 2009, the Great Recession. That being said, here's the yield curve, what we saw from Tom's comments. We got these from stockcharts.com. As you can see, we hit that zero mark. We saw an inverse. And with that, it's just important to just keep these things in mind, big news events when you're looking into this. So we just look into all these events because they can affect our TSP or our retirement accounts. And our goal with our retirement accounts is to make sure we are on track and preserving capital throughout. With that, let's go into the C fund, kind of a general overview. With the C fund, we did see that it was, we had it in a channel here based off of Tom's commentary, and he had it doing very well all the way in January and February and March. We decided to buckle out kind of when this trend started, right in the beginning of January, because we had such good increase, and I don't think that move was it wasn't the best move, because we continued to rise, but we did what we did, and we were at a very time when we saw this kind of 200 moving day kind of slanting downward a little bit. Now we're starting to see it slant a little upward, but we have broken our main channel trend. So we are now below that blue line, which is right in the middle, and we broke kind of our level trend line here. We're heading towards the bottom here. We want to see some support here for this trend to continue and for us to invest in this fund. That being said, we did see a decrease here with the funds, and we're just going to have to see where this goes. We did see one decrease in March. We see another one here. The last time we had a large decrease, if you keep in mind, was back in December, and that's when we had one of the worst Decembers on record, going all the way back to 1937. With that, we had the 10-year Treasury note and the 3-month note close. Okay, it's the first time in about 12 years that this has happened, so that's pretty something significant. Whenever you have a significant event in the markets, it's just important to point it out, make investors aware of it. So I'm just letting you guys know. It doesn't necessarily mean anything, just keep a note on that. Moving on to our small caps, or the S fund, VXF. With that, we have kind of a big decrease here. That got hit really hard. We saw a big change, and technically with that, we saw a lower high and a lower low here. So lower high here and a lower low here. We broke our trend line. We are now below that 200-day moving average, and are moving below this 50-day moving average on this chart for Tom's commentary for the this is the Russell 2000, or small caps. Anyway, so just keep that in mind. Moving on to the I fund. The I fund, we did hit some resistance, but we still have a lot of key support here. We have the 200-day, the 50-day, and a trend line here. So we'll keep looking to that, but we're not just invested in this since this fund has been in a bear market for quite some time. Still not really interested in this fund until we can see it consolidate above that 200-day moving average. And lastly, like I said, we have the AGG, or the F fund. With that, we've seen significant increase since March. We've seen it go from about 106 to about 108. That is the largest increase we've seen in a 1 month period in a very, very long time for this fund. It is doing very well, and it might be a very good place to start sticking capital for a short-term basis instead of the G fund, especially with the yield curve inverting and interest rates holding off. That means the G fund will continue to decrease, and we'll get even less than 3%. Last year we made 3% on the G fund. We'll get less on that this year without rate increases. So the G fund will even be less if you have money parked there. And this probably, the F fund would be a better place to park your capital now without interest rates, with the Fed clearing that interest rates will not rise for the immediate term. And with the F fund going up, we can make actually a little more money in the F fund than the G fund when we're trying to guard capital. So just keep that in mind. Again, it's a short-term fund, but this is very positive for the F fund. We have not been positive about the F fund for a very, very long time. That being said, let's look at one more kind of general overview, a short and long-term view for some of our funds. This is GROWMYTSP. You can follow them through this website right here at the top, info@growmythriftsavingsplan.com. Great commentary here as well, just getting a couple different perspectives on the market. So like that, we're going to be looking at kind of a long-term and a short-term post. And again, they noticed two events as well this week, which I already mentioned. So with that, we had the long-term perspective. This is the 12-year weekly chart for the S&P 500. Shows the market correction from 2007 to 2009, and then the rally from 2009 to 2018. Some would call 2018 a correction. Some call it a bear market. We did not necessarily get the 20% mark, so technically it would be a very, very bad correction. But when we look at this, they use the wave formula for that. They say we had our first wave back here in 2010, second wave in 2012, third wave, fourth, and our fifth wave here. But this is a question mark whether we can get a higher high here and make that fifth wave or not. So they're looking for the higher high here and trying to figure out if we can see this on a long-term basis. This is really good that we did bounce off the 200-week moving average here, and now that we are above, consolidated above the 50-week moving average. We'll have to see if that holds or if it fails. If we do end up missing some of this resistance, we could see a long-term move down. I don't necessarily think we'll see that, in my personal opinion, when we see with charts, but I could see some people have talked about a head and shoulders pattern forming. I think this could be a kind of a left shoulder here, a head here, and we could see a right shoulder forming here. I don't think we'll get a move all the way back down here. I'm not predicting anything, but just based off of pattern activity in charts, which I'll show you a little later on, I think we could see just a little bit of a decrease here. That being said, we have our indicators down here, our RSI and MACD. We are seeing an increase with that, and an increase here. Not in the green yet. Typically when we hit the green, we see that for a little while, and then it tends to go down. Been down for a while now, on its way back up. On the short-term basis, like I said, we saw the federal chairman basically made his comments on Wednesday afternoon. We saw a little bit of impact on those remarks, and then we saw a reverse on Friday due to the yield curve. All right. We'll have to see if we can hold these key resistance lines. So here's one of the key resistance line they have. They have this line drawn across here for resistance. As you can see, we're at that mark here. We can see if this holds or not based off of our charts, which I have pulled up here. We're seeing a weekly decline on our charts. I'll go into this a little bit more later. So we could see that break that resistance line there and head all the way back down to around this level, around the 200-day moving average. I could definitely see something like that happening. We'll have to wait and see on that, and just go from there. As always, we're in the green on the short-term basis, so we're headed back down. Usually when we want to try and buy when it's in the red, or just watch our indices to see when they're coming back and then buy in the red. So we'll have to wait and see on that. That being said, we're going to keep moving. Our S fund collapsed through its 200-day moving average and is sitting on the 50-day moving average. So we have that. If that does not hold, the S fund is likely to go lower. So we're waiting to see what will happen with that. Again, we have a weekly decline on our charts with what I have here. So we have to be careful in watching that. Not the best time to invest here. I foresee a lot of consolidation here, especially with that pattern. Now, you don't want to predict anything, but this is usually, we see a head and shoulders pattern that usually means a very bullish, inverse head and shoulders means a very bullish sign for the future, but we don't want to catch this shoulder moving down at this point, and we want to watch our charts very significantly, and then put our whole full capital in harm's way once we know charts are going to increase for sure. Now, we never know anything for sure, but when we have the probability of when charts are going to increase before. So I foresee probably some consolidation here for the S fund or VXF before it decides to move forward with a higher move higher. As you can see, we have the indicators here, RSI and Williams percentage R. So as you can see, we're getting to that point here where we want to maybe focus on buying again, just not yet. So we'll have to wait and see on that just a little while. And we're right here, so I would give a little bit of time, guys. Let that consolidate just a little more before we decide to move into that S fund. The I fund collapsed down to its 200-day moving average. We'll have to see if it can hold here. We'll just have to wait and see. It'd be very interesting with that. We've not been in the I fund for close to almost a year and a half, just because we did move a short term. I think back in September. In August we moved into that fund for just a little period of time, but that was just to gain a little capital out of that. It was not a long-term move. That being said, we're kind of right in the middle here, a lot of consolidation, waiting to see what happens here with our 200-day moving average. And of course we have the F fund. With that, we saw some big things happen with the F fund. So we have not been in the F fund for a very long time, have not considered being in the F fund, and not want to be in the F fund. The reason not, because the F fund cannot rise typically, or has a very tough time rising when the Fed is raising rates. Now that the Fed has said that they're not going to raise rates anymore, and we're seeing a giant, way more volume than we saw back here in 2016 or 17 or even 18, this is very, very, very good signs for this fund. We saw a breakout here. We saw a long-term breakout line break just before 2019, and once we had that, we broke out of that, and we've just seen it continue to rise after that. It might be a very good place for AGG or that F fund to stick capital instead of that G fund. It should make a little bit more on our money when we have positive charts for this fund. That's the key. We must have positive charts for the fund in order to safeguard capital when we're waiting for those stock funds or that shoulder to form, either case. So with that, we'll have to see where things go, but this is very, very exciting to see this chart and look at it basically, and possibly with we'll see hopefully the F fund be a little more competitive. If you look on our yearly stock funds, you can see that the F fund hasn't made a whole lot of money this year compared to our stock funds. But if stock funds are pretty much done for the year and they're going to stay within this percentage or in a range, we could get a good boost out of that F fund while we're waiting for those to go down before they come back up. And then that way we kind of are trading stocks a little bit to try and increase our percentage for what we have on the year. So I think that's a good strategy going forward, and we'll have to see how that pans out. With that, that is pretty much all we have going forward. It's important that we really keep an eye on some of the things that are going on. I don't think we're out of the woods just yet with our stock funds. They have been doing very, very well for the first quarter of the year, but as always, we must keep a close eye on that. Just like we didn't keep, when you don't keep a close eye on it for one quarter, look what happened fourth quarter of 2018. So it's important that we keep our focus and we keep moving forward. With that, we'll move more into our general analysis of each fund, and then we'll wrap up the video. So with that, we have IVV. This is the C fund. With the C fund, we saw it break its neckline a few times, very, very positive, very, very bullish, and then go right back below that line. We have a 200 moving day average of just kind of flat, and we're seeing that 50-day moving average getting very close to what we call a golden cross. Typically when they cross going down, that's called a death cross, and when they cross again, it's called a golden cross. Of course, that 20-day moving average is above, and it's consolidating above all three of our moving averages, which is very positive. If we look at it with our charts, IVV, here it is, on a weekly basis, we tend not to invest when markets are coming down off the top. They do go up maybe just a little bit, like we saw back here. A couple of weeks of where it continued to increase, and then we saw a massive decrease. So we noticed this, we saw this kind of back in very first of March 1st, and started to see a decrease, and it's been decreasing ever since on our 2-day chart. The only time we ever really invest in a decreasing weekly chart is when we have a positive 2-day chart. We did not see that on Friday's close. Saw a decrease as well, and we saw our blue line start to slip below that red line. Even on a 4-hour chart, when we're looking at it, we're starting to see more of a decrease. So we could see that right shoulder, based off these charts, we could start to see that right shoulder start to form for our larger pattern charts. And I'll show you that on our other things here. So we have kind of mutilated left shoulder here, a head pattern here, and we could possibly start to see a right shoulder start to form before we see charts go higher with a very bullish pattern. So keep that in mind. Moving forward, we'll go into the VXF or the F fund, seeing kind of a similar pattern here. We are below our 200-day moving average. Keep that in mind. It did meet these, it did not cross these trend lines that we have drawn in here, and we're getting close to crossing our 50-day moving average with consolidation below the 200-day moving average. Okay, charts don't look as healthy as the C fund. This is a little bit worse. So we have not been invested in this fund for a little while. And looking to our charts for VXF or the S fund on a weekly basis, we are also starting to see a decrease. Last time we saw a decrease in charts with this on a positive side was back in September, and when we had that, we had a significant loss of capital. Markets are really doing a big consolidation from this correction slash, we don't know if it's a correction or a bear market. It was just so close to the 20% decrease on the S&P 500 and the stocks. We're not really sure if this is just a correction or if it's going to be a bear market. And with that, we have to just be cautious, and that's why we've been cautious with our funds the last couple months. And we've just been waiting, sitting back, and observing some of the evidence we have in hand. That being said, let's look on it from a 2-day perspective. As you can see, we are starting to lose momentum, even more momentum with this. We've been losing momentum ever since mid-January when we pulled out our funds here. Again, we don't ever know how fast those funds will pull out or in. We just tend to pull out when we see that happening. So right around this time period is when we pulled out of our funds, as you can see here, and we've been watching it ever since, and it's been decreasing even though the market has been increasing. That's not always the case. These charts are not 100%. If they were, everyone would follow my channel. So this is just one of those periods where markets tended to go up and the indices tended to go down. We did have a blue line over the red line, so we could have interpreted that a little bit better, but we are getting really, really close now to where that line is crossed, and markets are now starting to consolidate, and we could see that left shoulder or the right shoulder start to form. So we were maybe late by a month and a half, 2 months, but like I said, you can never be 100% right with the markets. It's just better to take what you get, and if you know you're wrong, say you're wrong and continue forward. So we might have lost some percentage there, and we'll admit that as part of it, and we'll move forward with what we have. Moving on from VXF, we'll move into the next chart, which is EFA. This is our international markets. With EFA, again, we're not seeing a very good thing here. We're still seeing that 200-day moving average on the decrease, which indicates bear market. Indices are mixed. It's not beating our trend lines, and I'm just still not impressed with this fund. I just don't see much action with it. On a weekly percentage, we are on the down crease in a bear market. Usually I am not anywhere near wanting to invest in something when I see that. We're missing it on a 2-day, and we're missing it on a 4-day. So this is not a fund you want to be invested in, EFA or the iFund International Markets. That being said, let's move into our F fund, or AGG. This is our last fund for today. With AGG, we are seeing some great things from this chart. Okay, so we came out of a bear market. We came out of the Fed's increasing interest rates. Really had a crazy thing with the Fed saying they're going to continue to increase interest rates back here in December. Then in January and February, they were more dovish on that, and then towards the end of March, they said they were not going to be raising interest rates for the rest of the year. That being said, if they're not going to be doing that, we could see a great potential to park money into the AGG fund or F fund for short-term basis, why stock funds are forming or consolidating in their markets. This is by no means a long-term solution, just a place to temporarily store capital over the G fund, because the G fund is not going to make you any money at all. There should be no reason you're ever in the G fund other than to safeguard capital for a very short time period. And I think we've been in the G fund for almost a month and a half. So with the signal from the Fed that they're no longer going to be raising interest rates, with the 200-day moving average slightly peaking upward, and with it increasing outside its trend line here, we see great things for AGG based off of technicals. Does that mean it could go down and decrease? Of course. But based off our technicals, we see great things to park capital for a short time basis. That being said, let's look at our weekly chart for AGG. With AGG, we're not very encouraged to see this chart go down, down, down on our DO to oscillator. And charts were going increasing. That doesn't necessarily mean we invest though, but this week we saw a change. As you can see here, we went from a DO of 1.98 up to 2.59. So this would be a great time to move our capital, possibly from the G fund to the F fund, gain a little capital out of this while we're waiting for that shoulder to form or for stocks to consolidate, whatever they decide to do, and then move our funds back into the growth stocks where most growth tends to be for the TSP investors and for Roth IRA investors. But this is a very, very good sign. I don't know how long this will last, but as long as we have good signs on the weekly, we have good signs on the 2-day. Just had a 2-day cross after a lot of consolidation. This is the market guys in general saying, we don't know what's going to happen. We don't know. This is all market participants. You know, this is the best thing you can get out of the market is everybody deciding, making decisions off of this fund. Not one person, not one opinion, the whole market. So we were very, very mixed, very indecisive. Markets were just increasing slightly ever so after. And finally, we have a very good positive cross here. With that being said, let's move on to the 4-hour. As you can see here in the 4-hour, we also have an increase, and it's continuing to go up. That concludes all of our funds and a general overview of what we have. So what does that mean for us as a TSP investor or a Roth IRA investor for our funds? Well, we were in the past in the G fund kind of waiting to see where things were, if this was going to be a correction or if this was going to be a bear market. We still don't really have a very good answer on that. I think we're seeing a very bullish pattern forming. Doesn't mean it will or not, but we could see that. Some consolidation from our 3 stock funds and maybe a right shoulder, maybe not. But until we know for sure, we want to keep our capital safeguarded. And since the since we saw yields increase, the G fund is not really a good place for that. It's just not going to it's not going to give you much to begin with, but we have a better place to park our capital. So at this point, we decided to invest in AGG or the F fund. We put 100% in there with new monies going into that fund for a very short-term basis. That short-term basis will cease once we see a better opportunity in our growth stocks, because growth stocks tend to do better than the F fund. Our channel is doing pretty decent this year. We are positive. We're not doing as well as markets this year. We are a little behind. But as always, the year is not over until the year is over. So please keep that in mind. We saw that last year in 2018 when we were up over 12%. And then in the last quarter, stocks and everything else decided to take a dump for almost a bear market. If you guys have any questions, go ahead and write those in the comments below. Really appreciate you guys watching. Please like, subscribe, or share the channel. And we'll see you guys next time. That's another top-notch video.